Yeah. Yeah. So what we'll do, we'll start with a simple four asset portfolio, variance and covariance, same variance and covariance which we did in previous case. But here what we are going to take hypothetical portfolio where we are going to uh, do this the mean return, their variances, covariances, and later on the efficient calculation of the efficient frontier. So let's go. So okay, so you can't see my the advantage of using two systems is I can see what you are seeing. So okay, so let me share once again. Yeah. Yes. Yeah. So as you can see, we have this variance covariance matrix of four asset classes: 1, 2, 3, 4, or like A, B, C, D, whatever you want to call it, you can call it this way. And in the column A, we have the expected return, which is given here, like 6%, 8%, 10%, and 15%. So we have the variance covariance matrix given from A2 to D5, and then their expected return is given in column E. Now we have a portfolio X, which is also given to us, which has 0.2 of asset 1, 0.3 of asset 2, 0.4 of asset 3, and 0.1 of asset 4. So if we combine all of this together, what we get is the entire sum it sums to 1. It means we have the entire portfolio invested in these four stocks. Similar is the case with Y. So in Y also we have proportion of stock A is 20%, then next stock is 10%, then the third stock is 10%, and the last stock is heavily weighted with 60%. Now if we have to calculate mean of portfolio, so rather than doing matrix multiplication, we'll just multiply this x's with the expected return. So we can use a simple command called sum product, and we multiply this x with this expected return, and we get this mean of this portfolio. Oh, what happened?
So there is curly bracket. I think that is proving to be a problem at the start and the beginning.
No, just let me see. Something must have been. There is some virus problem. I don't know why. Just a minute. C6. I have rightly taken this value. This and then this and then y. No worry, nothing to worry, because this is always going to be the case somewhere or the other. So, so nothing to worry that way. We'll do it another way, and we'll see why it goes. Yes. Yeah. So I got the return. I'm surprised why it was, but something must have been there. So 9.1% return is the portfolio of X. So portfolio of Y also similar way. If we just do this way, and we multiply this Y with this expected return, which is ER, we get the return.
So you have selected one extra cell in expected return. That's why the value is.
C7, E2, yeah, E6 is one extra. Rightly, you have pointed. Good that you are more present that I am around this. So yeah, so this is 12%. So your portfolio X's return is 9.1 and portfolio Y's return is 12%. This is we got. This is the simplest thing that we could have tried. Now coming back to variance of X. So as we as if you are given the variance and covariance matrix and you have to calculate variance. So you multiply transpose of X with the variance covariance matrix and then the matrix X. So here what we'll do, or like you can do the other way also, but let's just see this when we are calculating variance of portfolio X. So we have to again use, because there are two matrix multiplication that we are going to face. And then this array of matrix, we'll select this array of matrix. Then we'll select this. Okay. And then we have to use transpose of this.
So you have to use one bracket at the end.
Yeah. Right.
Sir, also can you send this file to us right now so we can practice alongside?
Yeah. So I've sent you all the files. Don't worry. When we reach there, this is just like we are testing the very basic. Basically, we are starting the vehicle and we are checking the clutch and gear. Now, please download all the files that has been sent to you. Have you checked your email?
Yes, sir, we have downloaded the 3 files.
Yeah. So like if you download, then these are just 4x4. So if you just want to use it, just enter this 4. This will just require few seconds. Just enter because this is something. Let me check where committing mistake C6 to F6 C D E F. Okay, and A2 to D5, which is matrix. Fine. So this should be able to multiply x into y, and then C6, F6. Then here is problem.
So which formula we are using for the variance of portfolio X here?
Yeah. So when you use variance of portfolio, so the covariance is always given in case of variance, right? And because variance is the variation of an asset with itself, so you are multiplying the same matrix, which is in this case portfolio X with X, but you cannot multiply X with X. So first you have to multiply X with the variance covariance matrix, and then you take the transpose. Reason why we do this, good that you asked me, is we want to get one variance for this portfolio. And one variance means we will have initially we have 1:4 matrix, and then we are multiplying it 4x4, and then we'll multiply it 4x1, and then finally we'll get 1x1 value. So this is we are okay. So let me show you this, which is what if I stop sharing this and I can show you something. Yeah. So this, as you can see, okay, I think yeah. So as you can see, this the portfolio variance is given by the transpose of X into matrix X, the variance covariance matrix, and into the X. So I think, but if I take this transpose, can I multiply this? This is 4x1, and this is 4x4. So 4x1 into 4 into this will go 4x4. So this will only apply when X is in vertical format, which is what I showed you in the beginning. When X is in this format, then this formula is useful. When like you can say this X, when X is in this form and you take transpose, then what happens? It becomes a row vector. And then like you multiply finally with this. So either way you do, but like in our case, what I am doing is I'm multiplying X with the variance covariance and then multiplying with the transpose, which is perfectly all right, should not be a problem. But why it's giving the problem, let me check once again. Maybe
Sir,
there's
can
some.
you try a different function? So even in my Excel, I'm not able to find this mult function. But there is one called mode.mult and both
Oh,
have the
yeah,
same
yeah. Actually,
description.
there is some formula error. I just see this. This is a mult, and now they should be fine. My God, how can I miss this? Should be okay. Yeah, we got the answer. Yeah. So wait. I can show you. Actually, it's a. Yeah. Can you see this variance of portfolio X? Can you see this variance of
Yes,
portfolio?
sir.
Yeah. So where was the problem? I was writing just MULT, not MMULT. Matrix multiplication is MMULT. Okay. Once again, like just to be on the safer side, let me delete this. Okay. So what I'm doing is matrix multiplication, and again because there are two matrix multiplication, so I'm using 2 1, and then because this X is already in row, so I will not make a transpose of this. And then the second method that I select is this. Yeah, yeah, and then the transpose of that. Transpose of X. Then I close this. Then I close finally. Then I enter. So I get the value 12.16 for variance of X. Can you calculate variance of portfolio Y so that you become sure? Because in, like lots of iterations we have undergone and there were some problems. So can you try this for variance of portfolio Y with this? Just try, because then if you can't do that, lots of issues will happen. If you want, then I can send you this, but I think this you can just enter in your Excel. Just takes 5-10 seconds.
So can you show that formula once again, please?
Yeah, formula is yeah, just see this. If you want, I can enlarge it also.
So can you move the sheet a bit up so we can see the values?
Yeah, good. So thank you. Keep telling me anything that happens like this. Yeah. So 0.1, 0.01, 0.03, 0.05. These are the 4 values and then their variances.
So is the answer 0.2322?
Just tell me in percentage. No, sir. What you are saying? Point.
2322.
Okay. So let me calculate now. Since you have done it, so so I'm going to do. And I'm going to multiply this with the same matrix. Point 2034 is what I get. You also get something like this?
Yes, sir. 0.2034.
Yeah, so perfect. So I hope others should be in a position to do this. If no, then just copy this. This is very basic. So like as we move forward, we'll be doing securities market line and capital market line. So we'll be needing this formula. So if you have done this variance for portfolio X and Y, you are assuming that you are using 100% of X and Y. Now, to calculate covariance, there is slight difference between variance and covariance calculation is not very much, in the sense that in variance formula you use on the both the side of metric multiplication X. Here you have to use Y. That's it, and then you're done. So again, we will use this matrix multiplication and again matrix multiplication, because we're going to multiply two arrays of matrix. Like one is this, and then this is variance covariance, which will take 4 into 4. We'll close this bracket because this will give one multiplication, and then we'll multiply this with the transpose of the other one. Transpose of this one. So in earlier case, we were taking X and X or Y and Y. Here we have just done X at one place and Y at the other place, and we have got the covariance of X and Y. So just you also do, so that it is there in your, of course I can share this later on, but you do, it's better than you know. Are you done?
No, sir.
Okay, just finish it then.
So done.
Done. Okay, now that this is Cherry, right?
Yes, sir.
Okay, so have I pronounced your name correctly?
Yes, sir. Cherry.
Okay. So can you calculate now correlation, now that you have the other factors? Can you calculate the correlation? It's very easy. Like if you have doubt, it's only because like you have become so mechanized. You are mostly using machine and not using it memory the way you used to do tables 9 into 6 or 9 into 8 and something like that. So correlation is nothing but is a ratio of covariances upon the standard deviation. So if you have to calculate the correlation, so I will divide this covariance by, I'll better take this, so a square root of this into this, and I'm done. So correlation is 0.454, which seems to be correct. So correlation nothing, but just let me check once again. So the square root of this number is this, and I drag this down. So okay. So here if I calculate again correlation, divide this by this into this variance. Oh, I am getting a different figure. Really? It's a high correlation. It should not be the case. Yeah, so same. Yeah, so we did the right way. No need to repeat this here. Yeah, so correlation is nothing but covariance upon individual standard deviation. So we do this. So these four things are very important for portfolio selection, because we are only going to talk about how we select portfolio, how we select efficient portfolio, how we create efficient portfolio, and then we draw the capital market line, and then we also try to test our securities market line hypothesis. So this is done, which you, if you can say this is done. So we have variance of portfolio X, so at variance of portfolio Y, and then covariance and correlation. Now, because we are going to move to a frontier, we are going to create an envelope portfolio. So we'll be changing the proportion of portfolio X and proportion portfolio Y. Why? Because we don't know which proportion of them will lead to optimal combination. So that's why we'll keep it changing, and then we'll see the magic that as we mix more and more of X or less of Y, and then we have a frontier which is changing its direction from very least optimal or like suboptimal to the most optimal combination. So when I change the weight of X, so X becomes 0.3. I'm starting with 0.3. Then we'll do it 0.4, 5, 6, 7, like that. So if I take X as 0.3, then automatically my portfolio Y will be 0.7. So if I take X as 0.3, so then what will be mean portfolio return? So mean portfolio return will be 0.3 of X, which is this into this plus 1 minus the same this, because the other portfolio will be using in some other combination, and this is our return. So if when we combine 30% of X with 70% of Y, our mean portfolio return has increased to 11.13%, which is a very good return, considering that our portfolios of the stocks are giving us 6, 8, 10, and 15%, whereas by just mixing 30% of X with 70% of Y, you get 11.13. Now to calculate portfolio variance, we'll use the same formula. If you remember, in this slide PPT, in the PPT, I had written this formula that variance of a portfolio is nothing but a individual portfolio weight square plus that portfolio, and plus the other portfolio weight square, and into the variance of that portfolio, and plus the combination of 2xy and covariance. So let's see, rather than remembering this, so portfolio variance here is, we'll calculate like this. So this square, I will have to make it a square. Why? Because this is the way formula, and then the variance of X, which is this plus 1 minus then this weight, and again I will have to make it a square, into variance of Y because W1 is S square X square plus W2 S square Y square. And then the third term of the variance, the portfolio variance is 2 into this.
Covariance of X.
Yeah, you can do that also. Just a minute. I got something to go with that. Oh my God. There is some cursor problem. I'm stuck. I'm sure some virus is there, which should not be the case, but I don't know. So it's not letting me come out of this. So not a problem. I think it was it Someshwar talking to me this time, or who? Shubham, are you there?
Yes, sir.
So why don't you calculate the portfolio? Meanwhile, like, because I'm not getting my cursor is now okay. Yeah. So
So actually, I'm stuck in the correlation formula.
why correlation formula?
Sir, I use the covariance of X and Y upon a square root of variance of X and into square root of variance of Y, but I get a different value, sir.
Why?
0.35 something, sir.
What about others? Can others say what value they got?
Sir, I got the same value as you.
Can
Okay.
you share the file of yours, Cherry?
Yes, I will share it on the group.
Okay.
So I got portfolio variance as 0.5361. Or did I? No, I need to calculate multiply with the covariance also, and then enter. Yeah. So I got portfolio variance at 0.140598. So and variance is 37.49%. Standard deviation at 37.49%. So just check whether you also get the same variance and standard deviation.
Sir, in the portfolio variance formula, you have used the plus 2 into covariance of X and Y into the variance of X into variance of Y.
No. If you're
Into
using
the
covariance, there is
Yes,
no
sir.
point. You have to use variance and again the variance and variance of other. The formula for portfolio variance when there are two assets is W1 square sigma 1 square, W2 square sigma 2 square plus 2 W1 into W2 into covariance.
Okay,
So
okay, sir.
covariance.
I use
So
the weight of the.
yeah.
Yes,
So
sir.
weight of X is W1.
Okay,
Let me
okay.
write there also so that you remember it. So this is W1 and this 1 minus W1 when we say that is W2. So W2 equals 0.7. So this is how you do. And then you square W1 square, W2 square into their variances and plus 2 W1 into W2 into covariance. So this is how you get portfolio variance. So
So since the standard deviation is 0.37,
Yeah.
so we can expect that there is a slight high standard deviation in the portfolio, sir, because
So
it is
no,
around.
no, but yeah, so that's bound to be there. You know why? Because good that you pointed this out. So we are using this portfolio Y in substantially 70% of portfolio Y, as you can see,
Sir.
right? And portfolio Y is heavily weighted in the stock 4 or the asset 4, which is 60%. And because the return of that asset is 15%, so obviously their standard deviation also must be high if you just go by the capital asset pricing model, that higher.
Yes.
Yeah. So obviously, but because we'll be using a linear combination of all these, so we'll see also very little standard deviation also, and even somewhat higher standard deviation. So not an issue, because that's the whole purpose of this exercise, that if you have to draw an efficient frontier, we need the combination of all these portfolios.
And
So,
sir, what if there are two or three more than two portfolios? Like, what is a general formula for this to calculate the portfolio variance? Suppose if we have more than two portfolio X, Y, and Z,
okay.
then how do we calculate the portfolio variance, sir? We have to use just add the W3 square into sigma 3 square, and then we use the covariance between the X. So then how can we actually proceed if we have more than two portfolio, like a general formula, sir?
Okay. Okay. Just hold on. Good. You are Shubham, right?
Yes, sir. Yes, sir.
You are very intelligent. So good. So, how many stocks that exist in Indian market?
Sir, I don't recall, sir, how many stocks. More than 10, more than 20, 30,000, sir, I think.
No. That's overall in the entire world. There is something like 22 to 23,000 stocks are listed.
10, some 5,000 around, sir.
Yeah, 5,000 in India, but
Yes.
out of that 5,000, after 1,000, they are rarely traded once in a month also. So after 1,000, there are few, but yeah, 1,500 stocks are traded actively. Means some of them are traded weekly, and some of them monthly, like that. So with the formula that we are calculating, with this variance covariance, you remember the previous day we did 5 into 5, or did we do 5 into 5 or 10 into 10 variance covariance matrix?
5 into 5, sir.
Okay, so 5 into 5 when we did, it means we did the variance covariance of 5 into 5 matrix.
So yes, sir, we get the variance covariance of 5 into 5.
So similarly, we can do for 100 into 100.
Yes, sir. So the diagonals are getting the variances, and the other columns will give us the covariance between the variance.
IJ, matrix IJ will get the covariances, and II or JJ will get the variance.
Yes, sir.
Right.
I got it, sir.
So
From there, we can actually extract the data and use there.
Yeah. So basically, by doing this, you have host of the all universe there into your variance covariance matrix. Now, if you have the variance covariance matrix already there, so in your X's and in your Y, already you have not only two, you have thousands of those combinations. So what you are doing, you are only just varying this. So you don't need beyond X and Y, because with the convex combination in X and Y, we'll get Z also. And then we calculate the variance for that portfolio. We'll see also. We are going to do actually that. Why? Because when we are calculating the efficient frontier, we are going to check, because one of the proposition of the envelope portfolio is, if X and Y is envelope, so their convex combination will also be will be on the same envelope frontier. So we are going to test it, and we are going to show that once you get two efficient portfolios, their linear combination or their convex combination will lead you to the same frontier. And thereafter, it's not about the third, it's like any other portfolio. So any other, we'll get to know the variance, because we are interested in variance of our portfolio, right? And that portfolio, because you have already variance covariance matrix of the entire universe, so obviously you don't need to worry about that. You get my point?
Yes, sir. I get it, sir.
Okay. So and that anyway we'll do in subsequent exercises. So yeah, so with this we have calculated the mean portfolio return, the portfolio variance, and portfolio standard deviation. Now, if I change this 03 to 04, 05, 06, 07, 08, 09, 1, 1.1, 1.2, 1.3, 1.4, 1.5, 1.6 up till 2, what will happen? Any idea?
So 0 point up to 1, sir. Like we have to
Up to 1, no.
no, just the cumulative sum of all the weights of is 1, sir. So,
Right, but I can take it to 2 also.
So how is it possible? I'm curious, like how is it possible to?
Yeah. Very good question. So, but that's the beauty of like when you do something modeling. Along with that, you have the theoretical understanding of the whole thing. So what happens is, I borrow whatever I have to use for extra X. I will borrow and I will short sell portfolio Y, and that's how I do it. So let's say for very simplest very simple case. Let's say I have two situations: ICICI Bank and Infosys Technology. Most likely ICICI is falling. Most likely what? My ICICI is anyway falling. I'm not sure about Infosys Technology, but it must be stable. Largely, it should be relatively stable because the conflict in Ukraine and global conflict should not lead that much of issue with Infosys, because Infosys is more into software and services than ICICI, which is more into consumer finance and the banking related products. Now, what happens is, if I am bullish on Infosys and I'm bearish on ICICI, so Infosys I can, let's say I have only 10 lakh of portfolio. So, and if I want to buy 20 lakh of Infosys, so 10 lakh of Infosys anyway I can buy, and 10 lakh of ICICI, if I have also 10 lakh of ICICI, I short it, and that value I use it for Infosys. So Infosys become 2, ICICI becomes -1, and 2 minus 1 is 1. So overall my portfolio remains 1. So overall you can be 1, but individual weightings can be more than 1. So this is what. So when weight of X becomes 2, obviously weight of Y will be -1. Then only like the whole will sum to whatever is desired. Otherwise that's just not practically possible. But yes, one portfolio always it can be 2, 3, 4, 5. Anything is possible as long as there is efficient market for borrowing and lending. Someone should be willing to lend you money for the amount that you want to, and that's always the case because majority of traders are actually lending and investing, and that's why you see market when it falls very significantly. Why? Because lenders get their margin call from their brokers, because brokers can't wait for long to get their money back, and accordingly what happens, these sellers, they have to sell it fast, and that's why market has a precipitous fall, and the result is like you have more fall when there is a fall, but when there is rise the market doesn't rise that way. So that's how it is. Okay, so sorry. So moving on. So now what we are going to do, so I was asking you that if I change this combination of 0.3, 0.4, 0.5, what will happen? So just check here only. I'm going to do 0.4. So can you see this mean return is changing, portfolio variance is changing, and standard deviation is also changing? Can you see?
yes.
Sir, one query.
Yeah.
Sir, in weight 2, why not you replace the formula as 1 minus weight 1? Why is it independent?
No, I'm sorry, just come up again.
Sir, in cell number D22, won't it be better to put the formula as 1 minus W1?
Yeah. So that's I just wrote it. It's in I didn't write any formula. I just wrote numbers.
Okay, sir. Okay.
Yeah. To show that W1 I'm using is 0.4 and W2 I'm using it 0.7.
Okay.
So that you know. Yeah. So okay. So if I'm using it 0.4, so this is changing. Just see if I'm using 0.9, what is happening. So mean portfolio is slightly reducing, variance is also reducing, and standard deviation is also reducing. So it means X is giving me less of the moderation in terms of standard deviation. It's reducing. Okay, but return is also reducing. If I make X as 2, so what's going to happen? portfolio variance, now it is not optimal. Now this is somewhere where I'm going to be into uncomfortable. So okay, so this I can vary. Now if I keep varying the weight of X, I will have the different portfolio return, different portfolio variance, and standard deviation. If I plot the standard deviation of the this portfolio of X and Y, which its mean return, I will call it the frontier. Let me show you where it is. So I've already done it. So yeah. So what I'm going to do here is I'm changing the proportion of X to minus, and then getting the same standard deviation, and formula, as you know, is the same with the mean of X return with its weight and plus 1 minus W1 and into the return of that. So from minus 0.5 and increasing from there on, I come to 0 and then I come to 1. I can keep on increasing this. Then finally what I do is I select these standard deviation and mean. This, I select this, okay. And then I go to insert, then I go to chart, and like I can recommended chart, I can select this. The moment I select this, I have a chart. Can you see this chart?
Yes, sir.
Yeah. So this is the frontier that is drawn out of the combination of X and Y. Fine, because we kept on varying X and Y, and we created a frontier which we cannot call efficient because we don't know whether this is efficient or not. But we calculated a frontier of X and Y, and we wanted to see it. So I just come out of this. I will show you the more colorful one. Yeah, because this is also the same. So now that I have this the variance which is on X and the return on Y, so I have this frontier which you can see. So now whether this is efficient or not, so then I need to do a check. And check of what? As you know, we have this portfolio A, B, C, D, or 1, 2, 3, and 4, and their returns are 6%, 8%, 10%, and 15%. So if my portfolio, the frontier, is capturing all these 4 stocks, then I will call this frontier as efficient. However, if any of these stocks, 1, 2, 3, or 4, is outside this frontier, then I will not call it efficient. Why? Because why should then I be on this frontier? Because there are situations where I can select 100% of a particular stock and get better return and better the variance in terms of risk and return. So let's see that also. So what I've done here is, in this case, I've kept on again from -1 to decreasing up till 2.7. I have gone even further. The same portfolio from -1 to 2.7 I have done because I want to draw a bigger graph, and then I have calculated its variance, which is on this, and then the mean return. And again, mean return is very simple. Why? Because if -1 is the weight, so -1 into the excess return, which was 9 point something, and plus the Y will be 1%, 100%, and 100% to Y return, which was close to 13%, I think more. So combination of that should lead you to this return. So we have this two things, the variance. Yeah. So yeah. So we have this. Again variance and mean return of these two combinations of X and Y. Now what is happening? This again I draw in a chart. Okay. So I draw this X and this Y. and my chart is this one. As you can see, the moment I select my chart, you can see this. The area of the chart is nothing but the same X and Y combination of. Let me write here so you better understand the standard deviation. And this is mean. Okay. So when I select this chart, so automatically you can see where from this chart is taking. Now this chart is again a combination of all the X's and Y. So I will call it a frontier. If I combine all these dots together, and it becomes a frontier. So I see this chart as a frontier. Now I have another situation here, which is the 4 stock 6%, 8%, 10%, 15%. This is the beginning of our exercise where we showed you the 4 variance covariance matrix. So the 4 variance covariance matrix has these 4 stocks, one of which is 6% return, another is 8, another is 10, and the last stock which is 15%. And portfolio Y is heavily tilted towards this stock. 60% of portfolio Y is in stock 4. So what is their variance and covariance? Their variance is this. So if I draw this and this together to see whether this is efficient or this one is efficient, I come to this situation. If I can make it a little shorter, let me make it shorter. Yeah. So this graph of mine, the moment I select this graph, I get selected this. So this stock 1, 2, 3, 4 is falling in this. So I have drawn 2 charts. One chart is of like the various X and Y, and one chart is of these 4 stocks, their variance and return. Why I'm doing is because I'm testing whether the frontier that I have created is efficient or not. So now the last thing that I have to do is mark this chart on this chart, which is not very difficult. I select this chart, copy this chart, and then again I come to this chart and I just paste it. If I do this here, I get this this combination, which is exactly the same. The first chart, the second chart superimposed on the first chart. Now just see this chart. The orange lines are our frontier of X's and Y, and then the blue dots are stock 1, stock 2, stock 3, and stock 4. Stock 1 is outside this frontier. Stock 2 and 3 is inside this frontier, whereas stock 4 is above this frontier. If you ever happen to see a situation like this, you can, without making any thought, you can just say that the frontier that you have created is not efficient, and therefore you cannot create efficient frontier out of this. You cannot draw like a capital market line, or you cannot have a security market line later on when we talk about that. So first is it's not an efficient. Why? Because by definition, an efficient frontier should have all the envelope of all the portfolios and all the possible combination of the stocks. So because some of the stocks like stock 1 and stock 4 are outside this frontier, so this frontier is not efficient. The simple answer is this frontier is not efficient. So we'll show a situation where all the stock will fall somewhere inside this frontier, and we can very safely say that the frontier that we have created is efficient frontier. So let's go to some theory, because we need some theoretical background before we tell you how to calculate the efficient frontier. Because to calculate efficient frontier, you need understanding of risk-free rate, and you need 5 propositions. So let me stop sharing here and take you to the slides where I can show you. Okay. So what happens is this, as you know, this is because you have the matrix of return, then the matrix of the portfolio X, and then the covariance. So this much you know. So let's move to this the second slide. So in second slide, as you can see, we have the expected return, which is nothing but the transpose of x into r. And remember, here you are using transpose because x can be in the vertical array, whereas in our example we wrote x in the horizontal one, so you don't need to do the transpose of x. You can just write x into r, a matrix, some product also should be sufficient to give you the value of the expected return. Now coming to envelope portfolio. So the first question that can be asked to you before you, when you draw efficient frontier, is what is envelope portfolio? So the answer is, it's a portfolio of risky assets. So like you have all the risky assets of 1000 or 1500 that you can see in the market, which gives you the lowest variance of return of all portfolios, having the same expected return. So this envelope portfolio is that portfolio which will give you the lowest variance. Means there won't be any other portfolio in the universe which can give you lower variance than this variance, and then that portfolio will call envelope portfolio. And the efficient portfolio is the portfolio that gives you highest expected return of all portfolio having the same variance. So they are complementary, envelope portfolio and efficient portfolio, in the sense that an envelope is a combination of risky assets that gives you lowest variance, because we are concerned about the risk. So we draw the envelope portfolio from where we will have the efficient portfolio that will give you the highest expected return of all portfolio at the same variance. So as you could see, the graph that I showed to you, the chart that we showed to you, the frontier is not efficient. Why? Because there is some combination which is giving you better risk and reward, and which is not possible in your frontier. So we reject that. So when we call a frontier or a portfolio as efficient, if it can give you a situation where the expected return of this portfolio is greater than the other portfolio, whereas variance is lower than the other any other portfolio having the similar characteristics. So an efficient portfolio will give you will maximize your return. Means you won't get any other portfolio that will give you the same return, and that will also have the lower variance than this. That's not possible. Even if the variance is the same, this efficient portfolio will give you less higher return and maybe the same variance, or like less variance is also possible, but to the minimum it should have the same variance but higher return, and then we'll call it an efficient portfolio. Now there are 5 propositions for efficient portfolios which you need to memorize by heart. Why I'm saying this is to test all these propositions. You will need to recall this from memory, but while doing it in Excel or while doing the modeling of our portfolio, we'll not need it so much, because that will be easier. It will be easier when we do it on Excel, but at least the solid underpinning of this proposition is required. So just let's browse through this, and then I will demonstrate it in Excel that why this is so easy, but in theory it looks little heavier, because you are not used to understanding so many part of the theoretical background of portfolio management at one point, but when you do the calculation it will come easy. So proposition 1 is saying, let's say be a constant, and we use the notation ER minus C to denote a column vector. Now the ER minus C is nothing but the expected return of your portfolio minus a constant. As I will show it to you, this C is nothing but risk-free rate. It's 100% risk-free rate, but there are situations, and there was a gentleman named Fisher Black who did his model called Black model. So he has also used C as something which is not risk-free rate, but then the other condition is the variance of this, the covariance of this C with the stocks in our portfolio, which is like the portfolio X or Y or any other portfolio, should be 0. So that's a condition, and that's only possible, mostly possible, when C that you are using is risk-free rate. So for all practical purposes, if you remember, this ER minus C is the expected return vector minus the risk-free return. That will be okay. That should be okay. Absolutely no issue. But assuming that like you live in a country where there is no risk-free rate, because there is no guarantee that even the sovereign can not default. They cannot print their own money, so there is no risk-free rate. And then in that situation, you have to take a proxy, like anything that like bank deposit or anything that can give you certain fixed return. And but the variability of that with the stock market return is 0, then that satisfies our requirement. Now, having known this, we are looking for a vector Z. So this is the only important in this whole efficient portfolio or calculation. So we need a vector Z, which when multiplied by the variance covariance matrix, which is nothing but S, this S. So when I multiply this Z, which will be a column vector, we'll show it. When I multiply with S, I should get the same this risk return combination of vector ER minus C. Now, you have the variance covariance given always. As you know, you will always be given variance and covariance metrics. Even if you are not given, you have a 10 into 10 return of 10 stocks, 20 stocks, or Dow Jones 30 or S&P 500 return. So expected return can always be calculated. And then once you have the expected return, then you subtract the expected return from its return over the period, and you get the dx dy. And then variance covariance matrix is easily calculated the way we did it previously. We are also going to do today in another way. So I will show you. Now, the $1,000,000 question is, how do you get matrix Z? So to get matrix Z, we need the inverse of matrix S, which is variance covariance, and we multiply with ER minus C, which is nothing but the expected return minus a risk-free rate of return. So if you multiply inverse of matrix S, which is variance covariance matrix, with your return vector, you get matrix X, matrix Z. And from matrix Z, how do you calculate X? So we calculate X just by dividing each of Z by the whole of Z. So for example, let me mention here only. So let's say you get Z like 0.3, 0.4, 0.5 and 0.6. So let's say you get something like this: 0.3, 0.4, 0.5 and 0.6. By doing this calculation, Z equals S inverse into ER minus C. So then your x1 will be 0.3 upon the whole of this 0.6, 0.5, 0.4, 0.3. So which is 1.8. So 0.3 upon 1.8 will become x1. 0.4 upon 1.8 will become x2, and 0.6 upon 1.8 will become xn, and then you get the portfolio X, which is what we are looking for. Once you have this portfolio X, you have got the one envelope portfolio. So one envelope is done, then you look for second envelope, and by theory, okay, so we are yet to do the 4 more propositions. So let's move to the next proposition. Okay, so as this is showing you, so X, how you get is divide each of Z by the summation. And how do you get Z? So you get Z by multiplying the inverse of matrix S, which is variance covariance matrix, okay, with what? With the expected return minus C. And once you do that, then you have the Z, and once you have Z, then you have X easily, because you divide each of the component of Z by its sum, and then you get X. So X is, the moment you get X, you get one of the envelope portfolios. Done. And that's it. Rest all is following in a similar way. So proposition 2, which is comes from a theorem which was proved by Black, that any 2 envelope portfolios are enough to establish the whole envelope. So for example, in our example, we had X and we had Y. And as you could see, I was varying the proportion of X from minus 0.5 to something like 2 point something, or minus 1 to 1.7 or 8. Means I did all the possible combination of minus X to plus X, and more than 100% to less than 100%, something like that. So by doing this, I created a frontier. So what black also showed is that if you have two envelopes, so you can have the whole envelope created out of X is 1. This is very important. We'll test this proposition later. So what black is saying, that if you have X as one envelope and Y as another envelope portfolio, so convex combination of X and Y. So if X is 0.3, which is A, so 1 minus 0.3 is Y. And then this combination will come as an envelope portfolio, and which is what we did. In fact, we have already done all these propositions, but I'm just narrating it because this is required. And you may have to, if someone asks you, let's say you go for an interview somewhere and someone tells you that can you calculate an efficient frontier out of the Nifty 50 stocks or Sensex 30 stocks, and your answer should be yes. How do you do it? So first you need variance covariance. Then once you have a variance covariance, then you need the expected return, and then you need portfolio in combination, some combination of the, and you keep testing your you keep drawing the frontier, and then somewhere you'll get to know that where is your market portfolio and how much you want to mix market with your risk, and where is the line that you can draw. So so the combination of X and Y becomes an envelope portfolio. So this is like you have to remember, because all you needed to just create two envelope portfolio and you're done. Proposition 3 and proposition 4 are the same, so you don't need to worry to memorize this, but they are like the different cocktail, in the sense that in one there is more water, in one there is less water, but the cocktail remains the same. So if Y is an envelope portfolio, then for any other portfolio, whether it is an envelope or not, if the relationship is expected return of X equals some C, which is a constant, plus beta times the beta of this portfolio X, the return of Y minus C, then where this beta is nothing but covariance upon the variance. So if a portfolio Y is on envelope, so then you can have any other portfolio X that can be defined by a linear combination of by this linear relationship with the Y in the form of C plus beta X E R Y minus C, and this is nothing, if you remember the capital asset pricing model, this is basically the same thing, but it's coming in terms of this proposition. So just wait and we see the okay, and as this is saying that see the expected return of all portfolio Z whose covariance with Y is 0. This I told you in the beginning also, that C, the C that you are selecting, it should not be varying its covariance with the portfolio and Y. In this case, Z Y is 0, should be 0. Why? Because if it is a variable with any other portfolio, it means when market is down, your fixed rate is also down, and then you cannot have a fixed frontier or like fixed capital market line. So that's why this is important to be sure that the covariance of this C with Y is 0. So moving on to proposition 4. If you see the proposition 4, this is nothing but this is the same proposition 3 written, but what it's saying that suppose that there exists a portfolio Y such that for any portfolio X the following relationship holds, that ERX, the expected return of portfolio X, equals a constant plus beta times the expected return of portfolio Y minus C, where beta is nothing but covariance upon variance of Y, then portfolio Y is an envelope portfolio. So in case 3, the Y was already an envelope portfolio, and then any X could be drawn in the form of Y. Whereas proposition 4 is saying that even if it's not the same, but if you can have a portfolio X regressed in terms of portfolio Y, the return of portfolio Y, and you get a beta and constant, then portfolio Y is an envelope portfolio. Later on we'll show you it's nothing but this Y is actually the market portfolio, but for the moment just be on the proposition. And so market portfolio M is a portfolio composed of all the risky assets in the economy. with each asset taken in proportion to its value. So finally, we need this market portfolio. Why we need market portfolio? Because you can't get any other portfolio which can give you a better risk and return. If all investors, this is what Harry Markowitz said, and he got Nobel Prize for this, what we are doing today and what we have done before, is if all investors select their portfolio on the basis of risk and return, then this is the combination that an investor should be in, with some combination of the risk-free asset and some combination of the market, or other way around also. Like it could be more of that also. So this is not very important, but this is the same thing that we are repeating, that expected return of R is nothing but a risk-free return. If there is no risk-free return, then any return that has the covariance with market as 0, and then beta times the return of market minus ERZ. In case there is no risk-free rate of return, so we use ERZ, and this portfolio Z we assume that has a variance of 0, covariance of 0 with market. So now coming to the proposition 5. So proposition 5 is again proposition 3 in a little refined way, that if there exists a risk-free asset with return RF, so this could be your central bank rate of 5% or 5.5% GSEC rate of 3 years or 5 years. Then there exists an envelope portfolio M such that expected return of X is risk-free rate plus beta times ERM minus RF, where covariance, the beta is nothing but covariance of the two stocks, so means stock X with market and upon the variance of market. Then finally, these three gentlemen, Sharp, Lentner, and Mosen, what they said is, if all investors choose their portfolio only on the basis of portfolio mean and a standard deviation, then portfolio X of proposition Y is the market portfolio M. So basically, what will happen is, if you select your portfolio on this basis only, you will end up having some proportion of the market portfolio. So now we go and okay, so let's go to our Excel sheet and calculate the variance, this envelope portfolio. Okay, can you see this the variance covariance matrix? Hello.
Yes, sir. Yes, sir.
Yeah. Okay, so this is the same variance covariance matrix with which you started, and I've not moved beyond this. I've just copied this, and the same mean return of the port 4 stocks, 6, 8, and 10, and 15%. We are using two constants because as per the proposition 2, you need to envelope to create the whole envelope portfolios and then the envelope frontier. So we want to do this. So here what will happen, I will do this ER minus C, this minus $35, and this I copy it so that I get 1 ER minus C. Okay. Here also I want to do ER minus C, but here I want to use the constant 4%. So because this dollar is $35, and then I'm done. So this I get the ER minus C, 2 ER minus.
What is this constant here? The risk-free rate of interest? Or something like-
So at the moment, see, there are two answers. So you want the politically correct answer, you want the practically correct answer. The practically correct answer is this. This is risk-free rate. If you don't use risk-free rate, you are not going to go anywhere, because you know the arbitrage. There is a concept called arbitrage.
Sir, we know, sir.
Yes. So if you don't use risk-free rate, so there will be arbitrage, and this will not be efficient. So ultimately, it will come down to risk-free rate only. But as as a beginning step of this practice, just assume that you don't know what is the risk-free rate or whether this is risk-free rate or not. But all you know is these two, 0 and 4%, are the C, which has the zero covariance with these stocks, and that's why we have selected. So we have created ER minus C, two different ER minus C.
Okay, sir.
Now, yeah. So now to calculate Z, because you remember we need to calculate Z to get to know the efficient from the envelope portfolios X, which will be efficient as per our proposition. So what happens is we will get 4Z. Why? Because there are 4 portfolio 1, 2, and 3. So obviously Z will have the different proportion. So I will select an array of 4 here. 1, 2, 3, 4. Okay. And if you remember the formula for this, like Z, so Z is nothing but the inverse of various covariance matrix into ER minus C. So what I do is I write matrix inverse, because I know I want this inverse of this various covariance matrix. Okay. And this I want to multiply. So I need to go before. Oh, sorry. No, this is not. I need here matrix multiplication.
So you do M mult before and then do it.
Yeah, that's what. But I thought that it would allow me to go from here. So this is it, and then actually I should have selected 4. So yeah, so I got the Z. Fine. So from this Z, I will create X. So my X will be, just a moment. Yeah, that's fine. I can keep it bigger. So this will be this upon some $41. So I do this. Then I drag this down. Okay, so I've got this 4 X's, the X1, X2, X3. Just to check this, whether this is right or not, you need to do a check whether this sums to 1 or not. Because if it is not summing to 1, it means something is missing. Because there is no way it should not sum to 1. Now you'll ask the question that initially I told you, no, it can be more than 1 also. But if something is more than 1 here, then something will be less than 1 here. And then finally what will happen is it will the sum of the whole x's will come to 1. Similarly, we want to calculate y. So let's see y, how we calculate y. So to calculate y, again I will select the first z here, the second z. So let me write here z2, and this is z1. So z2 will again be a multiplication of matrix inverse of the A31 to D34 with this one, because this time we are calculating another portfolio with, okay, and then you have got Z2. So now if you want to calculate Y, so again the individual Y's will be this one divided by sum of the and then I drag this down. So you have got this Y also. Now that you got X's and Y, again check whether it is summing to 1. If it's summing to 1, then it's fine. So this portfolio X and portfolio Y, these are two envelopes that you have got. Now that you have got these two envelope portfolio, you need to calculate its mean and its return. Why? Because it's in proportion to the different stocks, and you want to know what will be its mean and what will be variance. So we will have to do the same mean for this portfolio X and mean for portfolio Y. So can you calculate mean of X? Can you calculate mean of X? Any answer? Hello?
Yes, sir.
Can you calculate mean of X now that you have X and Y? Yes, you can. So all you need to do is take this transpose of this axis, okay, with this one, then you are done. So you got mean of X as 0.093725. So you got 9.3% return of X. Okay. And a similar way you have to do for Y also. So just do here, right? Mean of Y. So
Excuse me, sir.
yeah.
So should we do M mult out there or should we do sum product for mean of X?
Either way, it's absolutely no issue. The
Oh
reason
yes,
is
you've taken transpose.
I'm sorry.
Yeah, because you've taken transpose, so it works out.
Yeah. If you
Yes.
transpose, then it works out. Otherwise, some product also, if you do, then it takes one element with the other element and just sum is sum.
Yes,
It just
yes,
takes
sir.
it twice. Some product is the easiest thing to do, but whichever you, it's the same thing.
Okay, thank you, sir.
Okay. So of course, both of them are in vertical, so some product will not be an issue here. So yeah. So mean of Y also need to be calculated. So again, we calculate matrix multiplication, and then the transpose, and then we got the mean of Y. Similar way, variance of X and variance of Y. You have to calculate. Similar way, you can do. Okay, so So similar way you can do the variance of x and variance of y, and then what happens, we do the same exercise as we did in case of the previous thing, that we keep varying x and y and we see whether this is efficient or not, this is containing or. So let's go, because we have already done and this will save our time. So we are here. This same thing is there. This various covariance matrix, and this is 4% and 0%, and we calculate the two portfolio x and y from this z. As you can see, the return is 9.37%. Return of y is 11.3%, and then the variance of x is 8.62%, and variance of y is 14.14, and then a standard deviation is just the square root, so nothing to worry. When you do covariance of x and y, as I told you, in covariance of x and y, there will be two multiplications. One is the vector x's multiplication with the variance covariance, and then vector y. So here what happens, we first take the transpose of the envelope portfolio, and we multiply with the variance covariance matrix, and then we take the another portfolio, the same portfolio, once the other portfolio whose value we have given in terms of x's and y's, and then what happens, we get covariance. So once you get covariance, correlation is just a formality. We divide covariance upon this individual standard deviation. So assuming that you you are okay till here, now what happens is, like, if we take x as 0.3, which is what like we can do it here, like when we were here, if I take x as 0.3, its mean will be this into this, which is this one, and then because 0.7 also will be the another portfolio, so 0.7 into this one, so you get this, and if you combine this is what you have, all this return of x's and y together in the portfolio. So this array is basically, the array that you're seeing is x's and y in the portfolio, and then its return. Now if I draw chart out of this, the standard deviation with its return, then what I get is this. If I select this, you will get to see this. It should come. Maybe so it is copied. So let me do it from here only. So I go to chart. I do this, and I say it okay. So I get a chart like this. Okay. Now that this is the frontier that I have got out of x and y. This is the frontier that I have got out of x and y. Now the same test I am doing, whether this is efficient or not. So the efficiency of this one can only be validated if I can see whether my Hello, can you hear me now?
Yes, sir.
Sorry. The internet got disconnected. I had to start the other mobile network. So yeah. So again, I will have to share it because we lost connection. Yeah. So as you can see, this is the frontier of yeah, and I get this frontier 8%, 10% and 50%. So I was asking you, and I think I got disconnected. So what I was asking you is, what is the variance of these four stocks, or the standard deviation of these four stocks? Any idea? Like you have all the figures before you, so you should be telling me that what is the variance of these four stocks, and this will also test your common sense, because the figure is before you, but you are not able to assimilate the concept. So if you can tell me what is the standard deviation of these four stocks, 6, 8, 10, 15, on the basis of whatever you just saw, or like if you can tell me where it is, then I can go and look for this. Yes, I want some of you to tell me, and then
So what are you asking, the variance, sir?
of this stock, and this we have the four stocks, right? A, B, C, D. Let me write here, so you becomes easier. A, B, C, D. These are the four stocks that I have that are in our portfolio.
Yes, sir.
Because we started with this portfolio only, and then we started with this variance covariance. Then we calculated its inverse matrix, and we calculated the ER minus C, and then we came to the X's and Y's, standard deviation, and the mean return. Now I'm asking you, because I have to calculate this particular thing with this frontier that I have calculated, because of with the help of two X's and Y. What is the standard deviation of these two portfolios? Yeah, tell me. What is that? Like, this is before you, but you should be able to tell me what is
Sir, we can
the
extract
variance.
it from the variance covariance matrix.
Yes, so exactly. So what is that value?
The root under 0.0, root under 0.1, then root under 0.3, then root under 0.4, and root under 0.5.
Excellent. Now, you could not have been better. Anything could not have been better. So if you can do that way, I think you done it. So you got this, right?
Yes, sir.
And then you, because the variance covariance matrix is there, so what you do is you do for this, and then you have this, and you do this. So, and then finally you take the square root of the last variance covariance matrix. There is some cursor problem, but thank God like it's coming to conclusion. So yeah, so this is, yeah. So I've got this 4 risk return combination of these 4 stocks, and I want to see whether the efficient portfolio or the efficient frontier that I have calculated is encompassing all these stocks or not. So I need to go to this again. So Yeah. So I have this chart. Uh, okay. Now I want to check whether this is the frontier that I have calculated is. So all I have to do is just superimpose this on this. But for that I need to have the same scale on the x's and y's. So let me check. This is 4, 5, and 6%. This is also this need to be, the scale needs this needs to be changed and then it's copied. But I will stop here because I want to finish something so that at least that portion is completed. So anyway, I will just share this with you. What you can do is, those of you, are you comfortable with Excel, or should I tell you how to do this?
So we can do it, sir.
Yeah. So just change this scale 0 to 0.8 in the similar way, 20% to 60%, and this the left side of this 0 to 16% to 4 to 15%, and then copy this and paste it, and you should find that this is exactly coming within this efficient frontier, and then you can say that the frontier is efficient because it's capturing all the possible combination of stocks. So that's one part of it. So yeah. So now the most important part is, what is the efficient frontier? Like if you have this envelope like this, which is x's and y, and you calculate portfolios of the combination of x's and y, because you keep varying x into 0.3, 0.4, 0.5, and ultimately what happens is y is also varying because 1 minus x is y, and then you get to a frontier. So let me show you something which is the PPT, and then get back to, yeah. So finally you get a frontier like this, which is what, like, so if you have really done a good work of starting something with like minus 1.5x to 2.3x, so your frontier will start from somewhere here until here. So what happens in case of efficient frontier is this: the lower portion is not efficient. Can you? I'm sure you must be knowing this, but can you tell me why this lower portion is not efficient?
Higher deviation and lower return.
Yeah, and you can rephrase it in better. For the same standard deviation, you have another combination which gives you higher return and the same standard deviation. So just rephrasing your statement only, because here what happens, you can, without incurring any extra losses, you are going to be on this side of the frontier where you are maximizing your return and keeping your standard deviation as the same, which was what we looked for, the efficient frontier. So this particular portion of this frontier is efficient frontier, whereas the bottom lower part is not efficient because, and as you know, these are like outside this, so this is not feasible, and this is feasible, but they will be not enveloped. And again, this, if you get any stock which is falling outside this, so obviously your frontier is not efficient because it's not allowing any other combination of the other possible universe of stocks. Now there is a concept called global minimum variance portfolio. Have you heard of this term called global minimum variance portfolio?
Yes, sir.
So what is that?
So the most feasible portfolio where the with lowest standard deviation and highest mean, sir, I think.
No. Highest means is wrong, but lowest is correct. But highest is return is I don't think
Yes, sir,
acceptable.
no highest means, sir. I think at just the this point, sir, where the curve actually bends down, I think.
Yes. Yes. So there is no other position on this portfolio which can give you the lowest possible variance of return or the lowest standard deviation. So no point on this frontier, entire frontier, whether it's efficient or not efficient, can give you the lowest possible value, which is called global minimum variance, and that's very important. So can you calculate global minimum variance portfolio out of the portfolio that we have given to you? Can you calculate global minimum variance? Do you know how to do this?
No, sir. Actually, we do not know how to do it, but we know the concepts only.
Okay, no. So that's important. So, and it's very easy. Like the 3-4 minutes that we have, I can tell you that, so that at least for one important. So let me share the slide with you, and then show you how we can do that. Yeah. So just go to variance covariance matrix. So this is our variance covariance matrix. Can you see this?
Yes, sir, yes, sir.
Yeah. So if I take the sum of the left one and divide by the sum of all the 4 ones, this will be my global minimum variance portfolio. But because this is 4 into 4, so it's very easy. You can do, but if it was 10 into 10 something, so you would need to multiply this with a row vector and row matrix and get the answer. But the simplest answer to this is if I sum it all this, sum it all this, sum it all this, and sum it all this, that becomes my global minimum variance portfolio. So if I sum column 1, that becomes my x1, and if I do the column 2, that becomes my x2. If I do column 3, that becomes my x3, and if I do column 4, it becomes my x4. So that is my global minimum variance portfolio, and that's something easier to do. But when you have the 10 into 10, you should not be doing this. I will tell you the formula to do this. We multiply the S inverse with the row vector and then divide by the sum of all the various covariance.
Sir, we have just class after 11:30, sir. I think, and
Yeah.
attendance will also
Yeah.
take time, sir. So it is
Yeah.
better.
So I will stop here only. But the data that I have shared with you, please copy it in your Excel so that we can work thereafter from the next class. Okay. Okay then. Okay.
Yes, sir.